Even smart real estate investors make this mistake, and over time, it can cost them $30,000 to $50,000 or more. Not because they're missing strategies, but because they're focused on the immediate tax result and not the long-term outcome. And the surprising part is this: most of the time, they think they're doing everything right. Now, what this looks like in real life is this: an investor buys a rental property, runs a cost segregation, and takes a large deduction, and expects it to reduce their taxes right away. Now, on paper, it looks like a strong move. But when you actually look at the full situation, it doesn't produce the result they expected. And this is exactly the kind of situation I see with real estate investors I work with. My name is Lisa Marie Odeja. I'm a CPA and an enrolled agent, and I specialize in tax strategy specifically for real estate investors. Now, many of these concepts can apply to profitable business owners, but working with real estate investors is my focus. Earlier in my career, I worked as a federal government auditor reviewing financial records and compliance. So, when I look at a strategy like this, I'm thinking about how they would be reviewed, not just how they look on paper. Because with real estate, it has its own set of tax rules, and that's where most of the confusion happens. Many investors are focused on the immediate tax result, not the long-term outcome. Now, what that means is this: decisions are being made based on what reduces taxes right now, without thinking through how it impacts future income, property timelines, or the eventual exit plans. So that's where money leaks happen. And right now, this is especially important because bonus depreciation is back at 100%. Now, it was previously scheduled to phase down and was expected to drop as low as 20%. But for qualifying property placed in service after January 19, 2025, bonus depreciation is back at 100%. So naturally, a lot of investors are jumping on that opportunity. But let me caution you here. Just because a strategy is available, it doesn't mean it should be used immediately. Because once you take that deduction, you don't get to go back and reposition it later. And depending on your situation, you may have used one of your most valuable deductions in a year where it mattered the least. A tax strategy should support your investment, not the reason that you make it. And this is where your approach to strategy really matters. Because when I work with real estate investors, we're not just looking at what strategies are available. We're looking at how everything fits together. Your income, your timing, your entity structure. So the strategy actually works the way it was intended to. Because the strategy isn't the starting point. The structure and the timing are. Now, that's the difference between knowing strategies and knowing how to use them. If you are a real estate investor and want to understand how to structure your tax strategy correctly, you can schedule a consultation using the link below. If this helped you think about this differently, like the video, leave a comment and share it with another real estate investor. And don't forget to subscribe so that you don't miss future videos where I break down real estate tax strategy and what actually works. Thanks for watching, and I'll see you in the next video.